Welcome to the F Sharp Podcast, presented by Harmony Wealth, a podcast geared to educate you on all things financial. Co-hosts Tanner Bortnam and Adam Henning discuss various financial topics presented in a consumable and entertaining manner. Tanner is a certified financial planner, JD, and financial expert, while Adam is a marketing professional and small business owner. It's time to harmonize. Sit back and enjoy the episode. Your future self will thank you.
Welcome to episode 47 of the F Sharp Podcast, presented by Harmony Wealth, a podcast geared to educate you on all things financial. I am your co-host, Adam Henning. I am joined, as always, with co-host certified financial planner, JD, financial expert, Tanner Bortnam. Before we jump into this episode, if you haven't yet, please like, subscribe, and leave us a review. If you have any questions or suggestions, shoot us an email at podcast@financiallysharp.com. That's podcast@financiallysharp.com. And also check us out on YouTube, search Financially Sharp Podcast, and don't forget to click that bell and subscribe to our channel. Episode 47 is part two of what we're calling kind of a two-part, that was terrible, two-part little series, little mini series. Part one was episode 46, which we called You've Been Named Executor of an Estate, Now What? Episode 47 and part two will focus on the inheriting part of the money and not much of the legal side and the executor's estate side. But you are the recipient. You could be an executor and still be receiving some money. But Tanner's going to walk us through this process, not as nitty and gritty as being the executor of an estate, but still should be some a pretty good info. So welcome to the episode, Tanner. I'll let you speak.
Hey, what's up, Adam?
As I take a breath.
Yeah, you did a good job. Good intro.
Have you perused the Reddit forums for any personal finance advice?
I did not. The one that you offered up was enough to keep me. Was enough for me for quite a while, so I'm good.
No, I did hear on the radio. It has nothing to do with Reddit or personal finance, but I thought it was interesting. It is financially related, but if you were to guess how much outstanding gift card balances are out there, what would you guess? Because I heard this little fun fact today.
Gift card.
I
have no idea. Absolutely. I mean,
47% of Americans say that they have unused gift cards.
Yeah,
which amounts
I'm not surprised.
To 23 billion.
Yeah, I'm not. And so think about that, right? Like someone might lose them. That make but also gift cards. I personally not a huge fan of them. I know that this has nothing to do with inheriting money.
But you could be inheriting gift cards.
I personally hate them because a lot of times you get to the point where it's like, it has $5 left or something on and change, and so you don't think about it. You end up throwing it away, or you end up not using it, or whatever. Well, someone paid. Let's say they put $100 on that. Well, someone paid 100, and you're only using 95. So you start doing that. Like, of course, companies love gift cards because, at worst, they use all the money that you were given, and it's a wash. At best, it's lost, or there's money that's left on there, and that's just a net profit. Like you didn't have to do anything for that. So, I think businesses absolutely love gift cards. I would have had no idea what to guess on the 47 billion. You said
47% of Americans, 23 billion.
23 billion.
Yeah.
I mean, I would have had no idea what the number was, but that doesn't shock me.
Yeah. My problem with it is always it's that obscure store that you go to once a year, and you do go to it and you're like, damn, forgot the gift card. And then you don't go back till next year, and then you just keep forgetting.
Yeah, I have two. I mean, speaking of, I have two of them sitting in my car right now as I think about it too. They're to a coffee place that
you gotta use the coffee.
Well, I know, but it's not one that I make my coffee at home. I have an espresso machine, and that's what I like. So I never really go out for it. Katie loves Starbucks. It's not a Starbucks card. So it's like it's a special thing to go out. And then, like you said, you get there and took the other car or whatever, and don't have the gift card anymore.
Well, I'll use it in 2 weeks when I come to visit you. How about that?
Perfect. Love it. All
right, let's hop in.
For you.
Let's hop in. You've inherited some money, a windfall of cash. What's the
Well,
first?
potentially.
Okay, true.
Potentially. You can
True. As I
inherit
look
lots of
down
things.
your notes, it's not necessarily cash. So,
Yep.
Mr. Smarty Pants, what's the first thing we do?
Well, actually, the first thing's going to be really similar to anyone that listened to our last episode. Is really just take some time. I mean, if you're inheriting something, again, odds are you know this person pretty well if they're giving you something. So take some time, process, help be with yourself, do what you need so that you can be, again, as okay as you can be, with losing that person that was probably very close to you. This is even less of a rush than the being the executor, the previous episode we did. There really is not a huge rush on any of this. Now, again, you don't want to drag this out for years and years by any means, but the executor is going to have to put some things in motion anyways before you, as the person inheriting, can receive anything. So someone else, unless you're the executor, but still you got to do some steps before you can actually inherit it. Again, go listen to our previous episode if you want to learn more about that. But it's one of the last steps where you actually give out the funds, right? You go through all these different things as the executor. It's one of the last things of giving out the funds. So you now being the person receiving an inheritance, you have time to before you're ever going to have to really deal with that. So don't rush into anything. Don't make any kind of knee-jerk reaction, impulsive decisions, because it's very, very, very important depending upon what you're inheriting. And we're going to walk through all these different things to consider, but it's very important that you don't step on some of these landmines that are out there that could, for lack of a better term, really blow up the inheritance that you just got. You want to maximize that if someone is going to give that to you.
Are you presented with a document, or what does it look like as we lead into the second step of taking it to maybe your financial advisor or going through your financial plan? How do you know? Is it just a phone call? Is it different for everybody, or is there a document that's certified or whatever?
Sure. I'll say a cop out. It's going to be different for everybody. It's going to depend on what you're inheriting. But most of the time it's not something that's super formal. The most formal things you'll find, if you're inheriting an investment account, for example, well, there might be a previous statement, that'd be about as formal as it gets. Here's the statement that, here's the assets that you'll be inheriting, or, some sort of retirement account, something like that. I guess if you're inheriting a home, getting that transferred over, that is a deed, to do that. So that's a formal document, but typically you're not, the executor isn't writing everything down and presenting you, this long list of all the things you're going to get. You're just going to kind of work with them on it. You're going to know you're the beneficiary of certain things. And some of them you might not work with the executor on because, again, for example, if you're beneficiary of a retirement account or an investment account, you're going to, once the executor tells you that, you're going to work directly with that financial institution wherever the assets are held to get that into your name or however you decide to inherit it. The executor depends, but should hopefully doesn't have a lot that they have to do in regards to that. Now, if you're inheriting a car, well, it's different, right? It just kind of depends on the assets that you're getting.
Okay, so now you know what you're receiving. Now what?
Yes. So kind of step two, you've taken your step one is take your time, right? Take your time, process everything, take your time to grieve. Step two is going to be create your own financial plan if you haven't. And I always harp on this. I mean, we always talk about sound like a broken record, right? Every time we talk about creating a financial plan, but you need to create, I'm a huge believer of this. You need to create your own financial plan and know where you're at and pretend like you're not getting this inheritance, even though you're going to get something, right? Start with, here's where I'm at. Here's everything that I have. Hopefully you already have a financial plan, so this would be easy. If you don't, pretend like you're not getting an inheritance and just look at your life, where you want to be, all of your situation. Because then once you have that, a further step down here is how you implement it into your plan. That's really the last one once you know the inheritance. But you will really want to know your own situation first. Again, work with an expert, someone who actually does financial planning. Every advisor out there says they do financial planning. It's crap. They don't. Find someone that actually does detailed, customized financial planning. That's another one, I guess, slight little caveat here that I've been running into a lot of is a lot of times, I hear advisors or other advisors or clients that, when I'm at seminars with other advisors or clients that, we're with a different advisor and it's always like, well, we use these models, we do this, we, model this, model that. Well, let me ask you this, right? If you're going to go to the doctor and you're 65 years old, do you want them to say, well, you turn 65 and at 65, we start giving everyone high blood pressure medicine and cholesterol medicine and arthritis medicine and, blah, 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 blah. The list goes on. Well, you might not need some of that, right? And you might need some other things. Like you don't want this cookie cutter thing that you just get lumped into, but that's what my industry unfortunately is, because everyone's trying to just serve tons and tons and tons of clients. Well, the only way you can serve tons and tons and tons of clients is by creating models and creating, these things and these plans that you just lump everyone into. Okay, you're similar, so you're all in this category. Well, no, we want it to be customized to you. So find someone who does that in terms of your financial plan. So do that, find your financial plan. And the reason I talk about this of really wanting to know where you're at and why I think it's an important step, if not maybe the most important step, is 70% of wealth is lost by the second generation. And we talked about this, I have it here, episode 39. So 70% of wealth is lost by the second generation, and over 90% is lost by the third generation. So that means we don't, as a society, do not know how to inherit assets correctly. And I think part of that is whenever this happens, a lot of times people don't have their own stuff figured out yet, right? It's just like, I don't really know what my plan is. I'm a young person or I'm a middle-aged person, and I'll get to that, but I just get $500,000 dumped in my lap. Well, if you don't know your own stuff and you don't know your own plan, how do you know that you're maximizing the value of that $500,000? You might use it for something and that isn't really worth it, or may not be the most valuable, or whatever it is. And so I think that starting point really, really is know your own role and know your own financial plan and where you're at. Then you can figure out all these other things in terms of the inheritance and how to maximize it and make sure you don't end up in that category of, squandering the assets within a second generation, or over 90% of it within the third generation.
I'm going to kind of do a little sidebar question here before we get to the next steps, step 3. Yeah. But this could be a potential huge opportunity if you have the wrong type of financial advisor to steer you in the wrong direction. Potentially, if you have a windfall of cash, bad actors enter here.
Yes. And not only bad actors, right? We hammer that on the podcast. You got to watch out for them. So yes, bad actors for sure. But I think even more dangerous is I don't want to say uneducated because they have licenses, but the non-experts that proclaim to be experts, the people that don't truly know what is all the pieces and all the moving, tax implications that could happen from particular types of assets that you're inheriting. And yes, we'll get into some of these, and these are the landmines that you have to watch out, that you need to navigate, or your advisor needs to be navigating for you. And if they don't know all the rules, they could be leading you right, down the landmine, and you could be stepping on one of them because they didn't know it was there, because they don't know all the rules. And there's a lot it's a lot more than people think. It's not just getting the cash and being like, okay, we're done.
So leading into that, many different forms, not necessarily cash, but different types of trusts, setups, forms of assets. What do we do? How do we help
Yep.
determine those assets that you're inheriting?
Yeah. Yep. So the next step, once you know kind of your own financial plan and where you stand on everything, then you want to find out what are you inheriting. So you need to determine the type of asset. This is very, very key, a key step in knowing, what the next step's really going to be, which is the tax implications of all of it and how it should fit into your plan. But the first thing you need to understand is, how are you inheriting this, right? So the first kind of branch or fork down the road is, are you the spouse or are you not a spouse? If you're a spouse, almost everything that you inherit, there are a few caveats, but pretty much anything that you inherit, you don't have to worry about a lot of these landmines, right? Because you're the spouse, it just gets moved over into your name, not tax implications. Basically that's a pretty easy path.
Do you have to be listed,
that
or is that just assumed for most things?
It depends. Again, hopefully you're listed. That makes it quite awkward if you're not. Hopefully, again, we're gonna walk down the path of assuming that the person that passed away had a good estate plan in order. If they do not have a good estate plan in order, all bets are off. It makes it even more difficult to know how things would play out, because now you're in probate. If they didn't have a will, you're in intestate, which is the state. And the state doesn't take the money. It just, the state has a set of rules. And since that person didn't choose how they wanted their assets to be distributed, it follows these generic state rules. And so we're not going to get into the super weeds on that. We're just going to assume they had a good estate plan. And so if you're the spouse, you're going to get, the assets. The transition will be easier. If you're someone else, this becomes significantly more important. Is it in a trust, or are you getting it free from the trust? Just a regular distribution, outright to you. And then another thing to think about is sometimes people leave a request for the funds. If it's in a trust, they can demand that the funds are used for X, Y, or Z. But if it's just given to you, if it's cash, 10,000 cash, and they say, I would like this to be used, towards X, Y, or Z for your life, do you honor that? Do you not honor that? That's up to you. There is no legal requirement for you to honor it, but that is what their wishes were. So that's something you have to consider. So you got to figure out how you're inheriting it. And then kind of while doing that, the same thing is what type of asset is it, right? Like, is it Social Security? So again, if you're a surviving spouse, you're going to get that. If you're not a surviving spouse, Social Security is going to go away. Again, with a couple caveats there of kids that are under 18. Is it a non-retirement asset like life insurance, homes, cars, regular investment accounts, businesses, all your household goods, checking, savings, CDs, things like that? Non-retirement accounts, that's one category. Is it a retirement account? IRA, Roth IRA, 401k, 457s, pensions, TSPs, anything like that. That's a retirement account. That's a different category. And then there's a third category, which has its own weird rules, which is an annuity. Are you inheriting an annuity? So you need to determine what is it that you're getting, because once you know that, then you can know how these, the next step, which is what is the tax implications going to be and how should you inherit it, to maximize the value in it.
You spend a lot of time transferring funds for this type of stuff in your day-to-day, of just having retirement accounts being transferred just due to estates? And
I have not so far in my career. I've been very blessed. I've had only 2 clients pass away. So very good, healthy clients, which is great, because it's not not a fun time obviously for their family or for myself. A lot of my clients, I become like a adopted nephew almost. So I haven't personally had a bunch of these yet in my career, but again, if the estate is set up, if the estate plan is set up well, yeah, you have to transfer accounts and do different things, but it's not a ton of work. And the financial institutions help with it, and you have to fill out some paperwork and different things. But it's usually not. If that part is not the burden. The burden is just making sure that you you do it correctly and you maximize the value, and again, don't step on one of these landmines and miss something or do something, and now all of a sudden you have this huge tax bill and you're giving a lot more money to the government than you ever really needed to.
Sure.
That's what we're trying to avoid.
Which leads us into the next one, correct?
Yeah. Yep. So now we're into the taxes. This is the, kind of meat and potatoes of it, because this is how most of the decisions will likely be made on how the inherited assets can best be implemented into your own plan. So again, we hit on it, the spouse. If you're the spouse, you get what's called a I'm blanking on this. A spousal rollover. Wow, that was not difficult. It
didn't take you very long.
Well, it should have been there right away. So it's a spousal rollover. And all that means is, again, I'll use Katie and I, right? If I pass away, Katie gets to take my retirement accounts, add them to hers, and just pretend like they're always hers. No taxes, nothing done. It just adds to hers, and now her accounts are combined, right? No taxes yet. And it's treated like hers. She doesn't have to worry about the fact that I'm older, anything like that. They're now just her accounts. So a lot less complex. The only time that you're really going to run into this is if there's a really old estate plan. I have seen this a few times and dealt with it. Just back when the estate planning rules were different, people created trusts for different reasons. We're not going to get into the weeds of that. But that could cause it if you're working with, a really, like, let's say, grandma and grandpa, you're getting an inheritance from grandma and grandpa, and they did their estate plan a long time ago, and one of them passed away, 20 years ago, and now the other one passes away now. Well, that could have, kind of locked some things in 20 years ago, and the first one passed away. That could cause this to be a little bit different. Actually, never mind. That's a terrible example. I apologize to everyone listening, because I was talking about a spouse. That would be a grandkid. So that'd be grandma. Anyways, you're really probably not going to run into this anymore. Let's just leave it at that.
What were you trying to get to?
Well, no, just
you're trying to make.
There are specifics. I'm trying not to get too much into the weeds and explains, but there are certain situations where, depending upon how estate plan is set up for different, very, very small percentage of families that need to do certain things, it may not just be as easy as a spousal rollover. There may be things that are in trust that are, kind of locked in, and they're set down their path already before the new rules came in effect. And so because of that, they have to operate under those old rules, which, anyways, it's too much into the weeds. We're going to move on. Just remember this, as the spouse, you likely are. Yeah. As the spouse, you get the spousal rollover, just add it to your stuff. Social Security. If you are the spouse, again, you will get this. But you don't get both. You're going to get the higher of either yours or your spouse's. You get one, whichever one's higher, the lower one goes away. Social Security will automatically calculate that out for you and give you the higher of the two. Now, if you're not the spouse, this is where the taxes become really, really important. First, you need to figure out, is there any inheritance tax owed on this? And this is going to be from a state inheritance tax purpose. Sometimes states will implement this on where the person passed away. Other states will implement it on where you, the person inheriting, live. So you have to determine, do you owe any inheritance tax, first off. Not a lot of states do it. I think it's 15 or less. The number 14 sticks in my head for some reason, but it's not majority of them, but some of them still do. There are federal inheritance taxes, but the exclusion on that is so high that if you're in that bracket, you already know what these rules are, because you're doing very, very comprehensive estate planning work to make sure that you pay as little taxes as possible. I mean, we're talking 40, 50 million plus estates. And if you're in that category, clearly you should know all of these things already. Or your advisors, whoever you're working with, definitely should have known it.
Yep.
Perfect. So if you're not the spouse, so let's just pretend you're the kid, right? You're the child getting an inheritance. So Social Security is going to go away. You don't get that. For non-retirement, remember these three categories: non-retirement accounts, regular retirement accounts, and then annuities are kind of the three big categories we talked about before. So non-retirement accounts, think of this like a home or a regular investment account, right? They get what's called a stepped up cost basis. So if my parents own a home and they bought it for make up some numbers, they bought it for $200,000, and when they pass away, if it's now worth $400,000, let's say it's doubled in value, that $200,000 of gain, if they sell the home, they would have gain. Now again, there's an exclusion on that, but regardless, they'd have gain. Whereas if I inherit that, we get a stepped up cost basis. So the cost basis goes up and now matches that 400,000. So I would inherit it, my sister would inherit it at 400,000, and we would not owe any taxes on that. That works with stocks too, right? So while we're talking about this as inheriting, slight caveat, this is also why it's super important to work with a person that knows a ton about taxes and all of this when you're in your retirement years, to make sure you're not selling the wrong things too, because there's a huge implication on that of what you want to keep. That's a great inheritance vehicle, and what you want to sell and what you don't want to sell based on what gets a stepped up cost basis and all of this. So non-retirement accounts get the stepped up cost basis. You will not owe any taxes on those types of accounts. Good with that?
Yep.
All right. Next category, retirement accounts. We're going to split this into two subcategories, pre-tax and Roth. So pre-tax, right? No one has paid taxes on this money yet. Again, I'm just going to keep rolling with my parents. My parents, in my hypothetical, let's say they have a 401k or an IRA. Let's just use that. They have an IRA, traditional IRA. No one's paid taxes on it yet. As they are in retirement, they're taking money out of the IRA. They pay taxes on it. If they pass away and there is still money in there and it gets inherited by myself and my sister, we will owe the taxes on that now. We have, under current rules, which again, depends on when you're watching this. If it's years down the road, they can always change. But under current rules, you have 10 years to get the funds out of there. That's the new kind of RMD, required minimum distributions. You have 10 years to get all the money out of there. So again, this is why it's important to plan and strategize the best years and the best way to how are you going to piecemeal that to get that out of there and pay the least amount of taxes. You probably don't want to just take it all out in one lump sum. That's going to throw you up into a higher tax bracket. You're going to pay more taxes than if you just take little pieces out over 10 years. But taxes are owed on that. So you will owe taxes. If you pass away with money that's in a pre-tax account, someone's paying those taxes. It's just whoever inherits it that's going to be paying them. Now, flip side of the Roth, you've already paid those taxes. So when again, my parents, now if they have a Roth IRA and we inherit it, we won't pay any taxes on that because they've already paid them. It is the single greatest inheritance vehicle is a Roth IRA, because no one will pay taxes on that money. And typically when kids are inheriting money from their parents or the next generation down, they're usually, not always, but usually in their 40s and 50s and at the peak of their careers making the most amounts of money. So they're already in a higher bracket. So to get a Roth is great because you can take that money out. Again, you have to take it out within 10 years. You can take it out, have a good strategy, but again, not as important because there's no taxes owed. So you can take that out kind of whenever you want, but it has to be out within the 10 years on that one as well. But amazing inheritance vehicle is the Roth IRA. Okay. Second of which, follow closely, I guess, second by the stepped up cost basis, because all of those taxes go away as well on any homes, stocks that have appreciated in value, those things that are outside of retirement accounts. Now, the oddball of the group, not to get, again, too much into the weeds on this, but annuities. This is why I despise annuities for the most part. We've talked about this, right? We have, I didn't look that one up. I guess we have an episode on annuities. Go back and listen to them.
I can
Annuities
serve a purpose.
themselves,
I'll look it up.
perfect. Annuities themselves are fine. They have a role. They have a purpose. The problem with them is they are oversold because they are high commission products, and the advisors who tend to do that don't understand taxes because they always seem to put them in the dumbest accounts possible. And I just sit there and I see, like, I just saw another one with a different client that we're working through, and I just want to, like, just scream at how stupid this is, because they're going to end up paying double the amount of tax that they otherwise would have if their previous advisor just understood taxes from just a little bit. You don't have to be a CPA, just a teeny bit that you understand some taxes, and would have put it in the correct account. But nope, they put it in a regular account. So here, let's go over this, right? Annuities have their own rules. If an annuity is inside of a retirement account, then the same rules will apply as what we talked about with a traditional IRA or a Roth, right? If it's in traditional, you owe the taxes on it because no one's paid. If it's in a Roth, which no one should ever put an annuity in a Roth anyways, that would be stupid. But if it is in there,
stupid.
well, no, because annuities tend to be sold as safer. And if people on podcast can't, well, obviously can't see me, I'm doing air quotes as I say safer, as safer investments. And a Roth is your best growth vehicle because you're never going to pay taxes on any of that growth. So, why would you put a CD that's going to earn you 4% in a Roth? No, you're going to put something in there that's going to get you 8, 9, 10 because it's growth. You want to grow that money because you don't pay taxes on it. So you don't put things that aren't going to go up very much, that are safer inside of a Roth. You can put that into a traditional IRA. That's fine. Do that instead. Make the safer stuff the traditional IRA and make your more aggressive part of your portfolio into the Roth. Anyways, if it is in a Roth, it's tax-free. If it is in a traditional, right? If it's in a traditional IRA, you're going to owe taxes on that, just like you would if you inherited any other type of IRA, traditional IRA. Now, the part that I was alluding to a little bit ago that annoys me to no extent is when an annuity is sold in a regular investment. You do not get a stepped up cost basis. What did I say was the second greatest thing? The stepped up cost basis. The Roth and then the stepped up cost basis. With an annuity, tax rules are you do not get a stepped up cost basis when the person passes away. You owe all of that as ordinary income, all of the gains. So if there's $100,000 of gains inside this, $100,000 of not even capital gains, ordinary income. Never, I probably shouldn't say that or can't. I have never come across a situation that an annuity as a regular investment is a good strategy because of that tax burden that you're like, why would you do that? Again, why? Like, I just don't understand. At worst, you buy ETFs or something else that is also safer, or income ETFs, anything. And if it grows like that, you pay capital gains. Plus you get a stepped up cost basis for your beneficiaries. Or you go put in an annuity and you lose both of those. You pay higher regular income tax and your beneficiaries are going to pay that income tax. Like, it just doesn't make sense. But ironically, see it quite often. So if you happen to inherit one of those like that, sorry, ordinary income, you got to pay it. Clear as mud?
Well, no, it's clear, but I mean, they can't really do anything about it. So if you're putting that together, don't make that mistake for the people that you're setting up.
Well, correct. And this and hopefully this episode is not only, it's geared towards people inheriting the assets, but anyone that's listening that may be creating an estate plan. These are things you want to think of so that you're helping set up the next generation to be able to inherit it in the best way possible. Because you're very right, Adam. If you buy an annuity inside of a regular investment account, your beneficiaries, they're stuck. They don't get a chance to try to inherit that efficiently. They're screwed. I mean, for lack of a better term, they're screwed with it.
Thanks,
So,
Grandma. You screwed me with your
well,
annuity.
here's the other aspect with that. I say that, I say that, but then it also, that's not accurate, because I'm also a very firm believer that any inheritance is a gift and you should be grateful for what you get.
Yeah, see your first line item there.
Right. Now,
Oh, wait. I don't know.
to
You said it
do
right.
another, right, but to do another devil's advocate to my devil's advocate, I don't know anyone who wants to give more money to the government in their estate plan. I haven't met a person yet that's like, yes, I would love to send more money to the government rather than my beneficiaries. So it is important. It is important, right? Be grateful for whatever inheritance you get, but also let's make sure that we maximize that inheritance that you do get and honor that person so that it makes your life the best that it can be. And for anyone who's working on their estate plan, whatever your age is, think about that as well. How do I set this up so that my beneficiaries can inherit this and that they get the maximum value out of it, rather than some of it or more than what is necessary is going to pay taxes? Because it's not like it's going to some philanthropic place. It's just going to pay taxes. That's it. It's just tax difference. So let's get more money. Let's work with a good advisor, create a really good plan, and think through these things so that you and your family or your beneficiaries, whoever they are, keep as much of the money as possible rather than giving it back in taxes. I think everyone would probably agree with that.
Fair.
Yeah. Well, all right.
You don't think the government's philanthropic?
No. And also, I probably shouldn't say everyone. I think the government would love to get more taxes. So everyone besides the government would appreciate a well planned out estate plan and financial plan that both the person who passes away has already implemented to make it easier and more effective for the beneficiaries, and then the beneficiaries do their part to make sure that they are inheriting it as efficiently and at the best that they can to maximize the value. It's two parties, more than two parties, but two parts that have to come together and work on this to make sure that the family or the group or whoever your beneficiaries are gets the most amount of money rather than just sending it to taxes.
I'm going to let you think of anything else that you want to add in the episode as I recap the 5 steps we went over.
No.
What? You're not going to?
Okay. I don't have anything else to add. So go. You can. Well,
maybe I'll spark
it.
something for you.
Oh, touche.
Okay. How to correctly inherit money, according to that man. 5-step process. You could coin that, make a book or something.
Probably should.
Step 1, take time. Take time, don't rush. Second thing, create or go through your financial plan with an expert, which is important. I think we say that in just about every episode. Step 3, determine the types of assets you're inheriting, whether it's in a trust, Social Security, non-retirement asset, retirement asset, or annuity. And then 4, understand the tax implication of each asset. Taxes. I think you said meat and potatoes. Roth is the greatest vehicle ever created, ever made.
I didn't say it. You did, but
I won't.
No, you can say it.
That?
I won't. Yeah, I won't. I won't contradict you. How's that sound?
Okay, that sounds. I'm not the one on the hook, so I guess I can say it.
Yep, perfect.
And finally, incorporate your plan. So, did you come up with anything during that beautiful recap that I just did?
No, that was so lovely. I think we should just end on that.
Sounds good. Hopefully your parents didn't throw that annuity in a Roth or outside. See, I didn't learn anything.
Oh boy. Looks like you're gonna have to go back and re-listen to the episode.
All right. Sounds good. All right. Thanks for listening. That's all we have for episode 47. We hope this episode has been helpful. As always, thanks for listening. If you haven't yet, please like, subscribe, and leave us a review. If you have any questions or suggestions, shoot us an email at podcast@financiallysharp.com. That's podcast@financiallysharp.com. Until next time, thank you, loyal listeners. Stay financially sharp.
Ooh, nice one.
How was that?
I like it. Well done.